Hello, everybody, and Merry Christmas to everyone if you're celebrating. And if not, but if you live in the West, it's likely that it's part of culture, anyways. So happy holidays to you. And to me, Christmas is an opportunity to reflect on gifts and perhaps get gifts. So I'm just making, a short video on the theme of what is the Christmas gift for stockholders. Really, well, it can't be these stocks being up. I mean, this past month has been awful. Everything has gotten so expensive. Now I feel bad paying these prices, but I think it's still very cheap compared to where it's headed, compared to where it's going to be. Remember, when a company grows 50-60% a year, the stock price should follow and also grow 50-60% a year, right? The price to sell should stay the same. What is a true gift? To me, that true gift that we have for Christmas and for next year is what? Is the analysts, the Wall Street analysts. Thanks to them, we still get amazing deals thanks to their analyses. And so really quickly, this is going to be a short video. I know I'm going to get very few views on this one, so let me just go really quick about what I think the analysts are giving us, why they're so great. Well, the first thing they're great is that, on this channel, I focus on hyper-growth stocks, and there's a lot of SPACs that are very inexpensive right now, and I consider HIMS to still be an example, the poster child of the cheap SPAC, of the company that has been sold off because analysts have gone on and say SPAC bad, SPAC bad. That's the reflection of the market, SPAC bad, without looking under the hood. And we even have analysts who have made ETFs entirely dedicated to shorting SPACs, right? ETFs entirely dedicated to doing that and just selling off. And if you look at the short ratio of all of these SPACs, it's very high, right? Close to 20% for your average SPAC. And that's the reason why we get some very good companies that were introduced as SPACs that are still suffering for that stigma and trading dirt cheap. One example that comes to mind is HIMS. This is a stock that I've been pounding the table on, and this is one of the few stocks that I'm very happy to keep buying at around $8 right now, because it's still very, very inexpensive in my view compared to all of the metrics that I look at, and the company is doing very well. I've covered the channel, the stock a lot on the channel, so I don't need to talk about it some more. What else am I thankful for? Analysts, what do they do? What am I thankful that they do? Well, I'm going to call this the competition is coming fallacy. And I see this all the time in the comment section. Oh, they have no moat. Oh, competition's coming. Well, this is something very recurring of analysts. Their assumption that competition is a constant and that businesses in the 21st century compete just like they competed in the 20th century, except competition is taking a very, very different form in the 21st century, and it's much closer to a cooperative competitive space than just a competitive space, right? It's much less cutthroat than it used to be, and that's why I believe it's foolish, for example, to keep saying for Tesla, competition's coming. That was the thing of Tesla. It's like you don't look any deeper. You're like, okay, they make cars, there's going to be competition coming, and you don't look at the competition and actually what are they doing? What they're making plans. They're saying they're releasing cars, but they're not doing that. They're not doing that because they can't. They can't because their structure does not allow them to build cars like Tesla. And I believe this is largely the same for this same commentary that we get about HIMS, right? Competition's coming. Well, there's fundamental reasons as to why this business is operating very differently. This could be the same for Enphase. This could be the same for CrowdStrike. How many times have I heard people tell me I should buy SentinelOne because SentinelOne is better and cheaper than CrowdStrike? Doesn't really work this way. Competition, when you have a complex product, when you have a product that is very hard to manufacture, competition is not as straightforward and not as easy as it used to be. And I'm grateful for analysts for talking about competition, because whenever they come on CNBC and they talk about competition, Tesla's shares get cheaper, and I think that's a gift. That's a gift from them. Thank you, analysts. Another one that I'm thankful for is the 12 months price target, and this is not just analysts, by the way. This is the entire Wall Street. It's all about 12 months. If it's not within the next 12 months, it doesn't exist. One of the flaws of this channel, honestly, is that I use 12 months out revenue growth. Why? Because that number is predicted so many times by analysts that really I'm ending up having to use it because it's so easy to get and it gets updated so often. But that's still 12 months price target, and it's very foolish to use. The proper way to do it, and this is one of my goals for 2024 in the channel, the proper way to do this is not a 12 months prediction of where the sales are going to be for any stock, but a 10-year prediction is the proper way to do it. Except doing a 10-year prediction is a much harder thing to do than doing a 12 months prediction, and therefore analysts just look at the next 12 months. As if the business did not matter beyond 12 months. As if the business was just going to shut down beyond 12 months. Right, there's other things that analysts do. For example, they've made the mistake, in my view, of trusting the Fed and just using the word Fed. The Fed said it was going to be higher for longer, and we knew full well when the Fed was going to pivot, it was going to be instantaneous, right? They would do a 180 in their language right away, like they did 2 weeks ago, right? But no, we're just going to trust the Fed and not look deeper, not look at the psychology any deeper. Let's focus on the short term. How grateful are we that so many analysts focus on the short term, and therefore they say our stocks, growth stocks on this channel, if you're new, I cover hyper growth stocks. Analysts, like the hallmark of a stock that I cover on the channel is an overvalued stock. Like that's the hallmark. All of the stocks I follow, you're going to find a lot of metrics that say these stocks are overvalued. Why are they overvalued? Because these analysts are focusing on the short term. They're like, oh, we're not making money now. It's kind of like these old quotes of the old way to do business. It's like, why should I pay for the price of what you're going to do tomorrow when I want to pay today? Well, because these businesses are exponential, because they grow very fast, because a company that has revenue growth of 50% as inertia, and it's not going to go from 50 to 10 or 5% revenue growth, the rate of the economy. It's going to keep outperforming and growing much faster than the rate of the economy, often for a decade. And this is a reason why I'm grateful for the focus on the short term by analysts, because when they focus on the short term, they say the stocks are overvalued, and a bunch of Wall Street sells off these stocks, and us as retailer can buy these stocks. No investment advice on the channel, it's just entertainment on this channel. But still, these stocks are cheap. I can buy these stocks, and I'm very happy. I hope they keep focusing on the short term, because most viewers of this channel and most investors, quite frankly, we are going to be net buyers of stocks. Like the only moment in my view where you're not a net buyer of stock is probably going to be in your 70s sometime. That's like going to be the only moment where you want the stocks to be very crazy high because you're going to be selling them more than buying them. But for most people, you spend most of your life working at your job and you're going to be a net buyer of stocks most of your life. So you want them cheap. So this is great. Thank you, analysts, for being short-term minded. Another thing that I love about analysts is that they want to, I believe that you should do a fair estimate. You should not be too conservative, because if you're too conservative, you're never going to touch plenty of great stocks, right? You should try to be as close to reality as you can. How many analysts do we see ignoring material components, very serious components of the business? The prime example of this is Tesla. When they analyze Tesla, they say, oh, we're only including the auto business for Tesla. How could you not invest? How could you not include in your price estimate for the stock? How could you not include FSD? If they solve FSD, right, that's much more than $100 billion of value if they actually pull it off. The present value today, with the odds as they are today, even if you take very, very low odds, that present value today is enormous and should be built into the stocks and should be built into valuation spreadsheets. And it's not. It's absolutely not. They're like, oh, we're only looking at the auto business, and then you end up with analysts saying that Tesla should be worth, $50, $70 a share. It never got there last year during Christmas last year. You may remember Tesla was cheap. It never got to 70, right? They ignore things like storage, even though we know full well storage is growing at 100% year over year. We have guidance from Elon that it's going to be bigger than auto, and they include that. And, if you follow the bot story, that bot story is entirely dismissed by Wall Street. It's not even funny how much dismissal there is of that story. Okay, it's being conservative, but being too conservative can just have you stay away from the best performing assets of the 21st century. That is my view. And the last thing that I'm very thankful for when it comes to Wall Street analysts, and I'm going to say, well, just in general, the Wall Street world in general, is the idea that bonds have a risk-free rates, and the idea and even the recommendations to just buy bonds. And I think this is an idea that is still a reason why stocks are so cheap, because as long as you have, the average 60-40 portfolio, as long as you have traditional Wall Street folks recommending 40% bonds, 60% stocks, you have fewer demand for stocks. My guess, if I were to guess, is that the younger generations are going to do crypto and they're going to do stocks, but they're not going to do bonds. They're not going to touch bonds. And so in the future, as this message of buying 40% of your portfolio into bonds, as this message gets diluted in the future, we may expect a higher value for stocks because you have more money flowing into stocks in general. And I am thankful that this industry still has the views and says to people out there, you should own bonds. You should own bonds. Take 100, subtract your age. That's how many stocks you should have. So if you're 40 years old, you do 100 minus 40, you should have 60% stocks, 40% bonds. That's kind of the calculation that they promote. And I'm thankful for that, because that means we have fewer buyers of stocks and we can still accumulate stocks for cheap. Remember, if you're under 70, or even if you're 70-ish, it's likely you're still a net buyer of stocks. It's likely you're still a net buyer of stocks, and you want stocks to be cheap. At least that is what I want. That is the way I look at this game of investing. I want my stocks to be cheap. So it's, I guess the gift is not cheap stocks right now, because they're up so much, especially if you follow the channel. Like, I'm so sad StoneCo is at $18, went 80% in like a month. I'm upset. But that's okay, because I'm still happy with the fact that we have analysts, and I look forward to them making our stocks cheaper next year as these stocks inevitably win in their marketplace. So long live Wall Street analysts. This is a video of praise of Wall Street analysts. Long live Wall Street analysts. You are our gift for Christmas. And Merry Christmas to everybody. This was not investment advice. This is just entertainment. Please like, please subscribe. Have a wonderful Christmas holiday and have a great day.